The Holy Grail. The Holy Grail. It's here. It's here. We found it. We found it.
Oh, that was strange. Don't know what came over me. Let's go. Well, that definitely didn't need like 10 or so takes to get right. Or g'day, and welcome back to the Forex Trading Robot. We've made it to episode 5, and this one's going to be super important, so make sure that you are paying attention. In this episode, I'll be revealing to you the Holy Grail of trading, and that's no joke. This will be the real deal, and it's probably the most important feature of trading that I can think of. And this will also probably be one of the most important videos on this channel that gets released. The Holy Grail forms the basis for a lot of what we do, and this doesn't only apply to FTR traders. The Holy Grail is universal and it applies to everyone. Not only that, it can apply to any general investment decision that you'll make. That's how universal and overpowered this will be. But meanwhile, come and check out this live trade that's clicking at the moment. It's a little bit spicy. Sorry, slight interlude while the markets are going a little bit nuts tonight. We've got Boston on show tonight, and he's already trailing his long position. And we've just had Hiroshima and Moscow enter. And they've only just started, so they're doing their little thing. But man, this NASDAQ position is going to be hopefully a big carry trade for the year, if not for the month of January. It's going really well. Hopefully it'll keep going. Smiley face up here means the EA is active and functioning properly. I'm not sure what else I can show in here for now, but it's just ticking along. Exciting stuff. Hopefully it keeps going. Current market shenanigans aside, let's go back to the Holy Grail, the super idea that helps you to create ripper portfolios. But firstly, this is what it isn't. The Holy Grail of trading isn't a single robot or EA that's going to rake in millions of bucks for you within a few months while taking pretty much no losses. It's very unrealistic. And it isn't some money management technique or martingale trading variant that just happens to never break. And it's certainly not some psychology related nonsense. The Holy Grail of trading is quite simple by design, but before we discover what it is, I'll have to define a few terms for us. But holy smackerels, we're still going. Look at this. 4 positions in for tonight. NASDAQ's decided to bounce around since. Got 2 NASDAQ positions open. One Nikkei and Euro USD is back in action after getting stopped out just before. And we're nearly up another $1,000 dues. And hopefully this time it'll keep running without getting stopped out again. I don't know. We'll see. We'll check in on it later. Alright, so that's enough sidetracking with live trading. I'll let that do its thing in the background. Let's get back to the actual content. So to help understand the Holy Grail, we need to understand what correlation is. And a lot of people might already be familiar with the term and its relevance to finance, but here we go anyway. At its basic level, correlation is a measure of how the value of 2 or more variables relate to each other. And it's measured with a correlation coefficient ranging between -1 and +1, with 0 smack bang in the middle, indicating that there's no correlation between the 2 variables. And at the extreme ends, +1 indicates that the variables are tracking each other pretty much identically. And at -1, these variables are pretty much doing the exact opposite things to each other. And putting this into the context of trading, finance, investing, and whatnot, this is generally referring to the correlation of return streams over a given time period. And for example, you might have 2 assets that have a 60% correlation to each other, meaning that within, say, a year's time frame, the return streams will rise and fall with each other 60% of the time. And you can imagine how stressy it can get if 2 of your trading strategies are highly correlated to each other, and they end up chunking your account at the same time and causing heavy losses. This is why, in most cases, lower correlation's better, because it's pretty brutal to go through this. And we'll get into why having some correlation is still a good thing a bit later on. So with that covered, here it is, finally, the Holy Grail. It is a mathematical concept provided by Ray Dalio, which he uses as a part of his hedge fund, Bridgewater Associates. And these guys had a ripper year last year. They pulled like 35% return from memory. And if you don't know who Ray Dalio is, then shame. Nah, kidding. Go look him up. He's pretty good at investing. Same tier as Warren Buffett. And his idea combines the variables of the volatility of an asset, the number of assets that you have within a portfolio, and the correlation between each asset. So let's have a look. And here it is, the actual holy grail of investing. So on the left axis, the y-axis, we've got the annual portfolio standard deviation. And this is a measure of downside volatility in our case. So up here we've got 10% downside volatility. And at the bottom we've got 1% portfolio downside volatility. The lower obviously being a lot better. And on the x-axis, we've got the number of assets or alphas in the portfolio, because we're all about alphas. And that's increasing off to the right. So 1 being you've only got 1 asset in the portfolio, 20 obviously being you've got a lot more than 1. And on the right here, we'll be mostly ignoring this. We've got the risk to return ratio. We're going to be assuming we've got a 1-to-1 risk to return ratio. And in the center of the chart, we've got our measure of correlation between each asset within the portfolio. And what we want to try to do here in a simulated portfolio is to try and get our downside volatility as low as we can. So the closer we can get it to 1% drawdown per year, the better. And there's 2 ways to do this. We can do this via increasing the number of assets in the portfolio that have lower correlation to each other, or we can do it by decreasing the correlation of the alphas. So let's do an example. Let's say we've got 10. We'll go 10 alphas in our portfolio, and they've all got 60% correlation. What we can do to lower our annual portfolio standard deviation risk, because at the moment that's landing at about 8.5, is we can try and decrease the correlation between these 10 strategies that we have within our portfolio. So if we get these strategies that are 60% correlated down to say a 10% correlation, we can get our downside risk down to 4.5%. So we've automatically dropped our downside volatility essentially in half just by lowering the correlation of the strategies. And that is a fantastic result to try and aim for. So let's look at the other side of it, and that's how to decrease your downside volatility via increasing the number of assets in the portfolio. So let's assume that our correlation is stuck. We're plebs and we can't get our correlation between our strategies below, say, 20%. And let's say we've got 2 assets in the portfolio because we're just starting out. So if we look at the chart, up at 20% correlation with 2 assets, we're floating around, 8.5%, 9%. And let's say we've worked out how to get a couple more assets bundled into the portfolio, also at 20%. Let's say we hit 8. We land here at, I'm blind, 5.5%, 6%. So by increasing the number of assets in the portfolio, we've managed to also decrease our downside volatility. And what you've probably noticed is that these curves taper off really quite quickly between, say, 1 and 5 strategies. And you'll really start getting diminishing returns the more strategies you put in. So the more you put in, the less effect it's going to have on your downside risk. And that's in contrast to reducing the correlation. So if you go to 60 to 40% correlation, you get a nice drop of, say, 2%. Same with 40 to 20, another nice drop. And it's quite consistent going down correlation. But the number of assets that you have, the more you have in there, the sort of more effort it takes to reduce that downside volatility. So obviously the sweet spot is by both decreasing the correlation and increasing the number of assets in your portfolio. But overall, what does this mean? Well, by decreasing your downside volatility, you are lowering the drawdown of the portfolio, but this is where the magic happens. Your returns remain uncapped. So you are not affecting your upside, you're actually capping your downside. And that's why this is the Holy Grail, because you're essentially smoothing out your equity curve by increasing the number of assets in the portfolio that aren't correlated. And by doing so, you start taking moonshots at your return to drawdown ratio, because you're really doing a good job at capping your drawdown, and your upside returns remain unchanged. And this is sort of what it looks like in action. I'm going to do a really crude example in Paint. How good's Paint? So let's say we've got a portfolio with one strategy going, and this is our strategy's equity curve over time. So it generally does all right. It's got an alpha in the market. It's got peaks and troughs of good runs and drawdowns, but it does it well. It does its thing. And then let's say we've got another strategy that is also decent. It's riding the market. It's also got peaks and troughs. Ooh, except for the Aramanco. And it has a good run as well. What happens is then if you combine these two systems to create a new portfolio, the overall equity curve will be a lot smoother. And that's because the downsides of one strategy are being cancelled out by the upsides of the other. And that's where having lower correlation between the strategies and an increased amount of strategies really over time starts to smooth out that equity curve. And for something a little bit more realistic, this is more of what it looks like in action. So I've just pulled in 3 random strategies into Strategy QuantX that I built from some time ago, I don't know when. This is our Euro USD strategy from 2003 up until late 2024. All of these should be around the same. This is our gold strategy. Looks alright. And this is our pound yen strategy. So they've all got a bit of volatility going on to them. And hopefully they should all be relatively uncorrelated. So let's see what happens to the overall equity curve of a portfolio when we merge these all together. So that's been created, and here it is, existing portfolio. And that's really smoothed out the equity curve of those 3 strategies, combining them into the one portfolio. This is an old one I was just browsing. And we can see here that the return to drawdown ratio of this new portfolio is 19.94. And if we go into the individual strategies, they will be a lot lower. So 9.96, 10.94, and 8.54. So that is the Holy Grail in action. We've combined 3 strategies together to smooth out the overall equity curve, get rid of the patches of downside volatility, and get an overall portfolio that is a lot smoother. And while we're on the SQX side of things, I'll just dive into a bit of the correlation analysis. So here's our portfolio again, the main equity curve up the top, broken down into its 3 components down here. This must be the pound yen strategy at the bottom. It's obviously not a high returner, so it's not overall having a huge effect on the equity curve compared to the gold and Euro USD strategies up here. But let's have a look at the correlation of these 3 alphas or 3 strategies that we've got going. See what they look like within the portfolio. So we'll go to strategy config. No, sorry, not strategy config. We will go to portfolio correlation because we're looking at portfolio, and we'll look at the correlation of returns by a day, and we'll go by profit and loss and allow negative correlation. And here's our correlation matrix. So we can see that, yep, happy days, it's in the green. They're all pretty uncorrelated, those 3 strategies. They're all sitting at 0.1 or less, which is great. So what are the ways to reduce correlation then to get some lower portfolio drawdown? There's so many ways, to be honest, that we don't really have time to go into depth in this episode for all of them. However, in brief, you can do the following, and this applies to all traders. You can diversify across timeframes within the one asset, and it's worth doing this first before branching out to other assets. And obviously you can diversify across your assets, so you can diversify between currency pairs, between equities, metals, whatnot. Dive into crypto if you want. You can diversify your price or entry indicators during the builder phase within SQX for all the FTR traders. You can diversify your money management methods. You can put in different trade closure conditions. You can diversify sessions within the market. I don't know, the list honestly goes on, but each different method will help you lower your correlation in your overall trading portfolio, and that will consequently lower your drawdown. And the best part is you get to keep the entirety of the upside. The profits remain uncapped, and that's why this is so good. So I'll start wrapping this up because I've been blabbing on for quite a while now. So in summary, the Holy Grail, it does exist, and this is it. It's definitely not about having a single banger strategy. It's about having a series of ideally 7 to 10 strategies that have low or no correlation to each other, that when combined they create a portfolio with an overall smoother equity curve than any of the individual strategies themselves. And this is achieved because combining these strategies with each other eliminates the patches of drawdown, while very, very importantly, maintaining the overall returns. And this is a super powerful concept to understand and appreciate, and it doesn't only apply to trading the markets. It applies to so many other things. It could apply to, say, a property portfolio you might be looking at building up over time. For example, you could diversify out across regions or property types to build up a steady flow of diversified capital gains. Or better yet, even your own personal investment portfolio. You can diversify that out across multiple asset classes from, say, fixed interest, share investing, CFD trading, job income, bonds, the list goes on. But overall, it helps to create overall steadier wealth gain for you over time. Cool, with that, I'm done. Hope you've all learnt something for today. And if you've liked the content, do hit the like button and subscribe for future content. And I'll catch you on the next one.